morning. I know a lot of you are out with testing, and I wanted to briefly go over what we're doing in class for the beginning of Chapter 9. So the notes, just to run through, we are now a merchandising business, which means that we buy and sell goods. You can think of us as Foot Locker selling Nikes. We have a new account called Purchases. The Purchases account is us as a buyer, and that's what all 4 of these refer to. So anytime we buy merchandise, so if I buy Nikes and Under Armour shoes to sell at Foot Locker, that's merchandise, and we call them purchases. Purchases is now a new $500 cost account, and expenses have become $600. This is not a supply to use for business. This is merchandise that would be resold. They will have a normal debit only, and then we also have 2 contra accounts. Just like drawing is contra to drawing is contra to capital. Purchase returns and purchase discounts are contra with credit balances to our purchase account. Purchase returns and allowances is when we buy something that we want to have returned, or we want an allowance given to us for a subpar product. For instance, we bought hats to sell and found out that the hats were of poor quality. We can call them up. Sometimes they might not want the hats back, but they'll give us a credit on our account for the bad purchase. Purchase discounts and sales discounts we are going to use to prompt payment. So a company may offer us as buyers a purchase discount, and if we send the money in early, we would get a discount on that. The benefit to the company is that they get their money sooner. The freight in account is the last one in the purchase series, and you can think of that like a delivery charge, very similar to an expense. It's when we are incurring the freight charge from the seller, and we debit that just like an expense, but it's considered a cost account. Hint, hint, test question. The other end of that is once we purchase all the merchandise, we become the seller, and we've already done sales before. It's a revenue in account. It's only credited. If a customer wants to return merchandise, we use sales returns and allowances, which would then be debited. We keep these accounts separate. And like purchase discounts, for sales discounts, we can offer customers we can offer customers a discount if they pay us their accounts receivable balance in prompt fashion. And the last one is sales tax. We have to collect sales tax according to government laws. It is a payable, similar to what we just learned with employee payroll. We have to hold on to the sales tax. It's a credit balance, it's a liability, and we send it to the government when it's due. Okay, we will be talking about special journals in time, so I'm going to skip that now. And then we have subledgers. And these subledgers, what happens is we might know in looking at the general ledger on the right that we owe $3,900, or we're waiting to receive $3,900 from a customer, but we don't know which customer it is. So that's why we have what's called a sub or subsidiary ledger, and it's a breakdown of our ledger. So this right here is going to be a new ledger, and it lists each of our customers and if they owe us money. And we can pull this up on QuickBooks just as easy when we're working there. So Borrow owes us $900. Bates has a 0 balance because they paid us all their money, and Landis owed us $9,000, paid us $6,000, so their balance is $300. And the new schedule of accounts receivable or schedule of accounts payable is exactly that. All it is a trial balance of who owes us money. It lists it, and the $3,900 here should match our controlling general ledger account. The last thing on our lesson is discount terms. Going back to those purchases or sales discounts, the term 210N30 or net 30 is the most common in industry. You might have seen it on a DECA test. What it says is you would be able to take a 2% discount if you pay your whole bill within 10 days. Or the net, the whole bill, is due in 30 days. So another term could be 115N30. Or it might simply just say N40, and that means that your whole bill is doable in 40 days with no discount. And a trade discount is what we're used to in a sales. You go into a store, 20% off patio furniture, and all we do is pay 20% off. We don't have to journalize these discounts. So that's our beginning notes. I want to show you 9.1a and 9.1b in case you're absent and you need to refer to that. And these are just journal entries. We are not using special journals. So you'll need to have these filled in to be able to do the lesson next week and to be able to do the B set. So on 9.1a in the book, it tells us that we work for Bell Florist. They sell retail. Most sales are for cash. However, we have steady credit customers, and these are some of them. So on March 4th, the first entry, it said we sold a potted plant on account for $27 plus sales tax of $135. So what are we getting? We are getting $28.35 as the total. How are we getting that we're waiting to receive? We had a sale of $27. We collected and held the sales tax payable of $135. So the total charge to the customer is $28.35. And that's what a couple of these look like. The next couple, we sold merchandise to Dixon, we sold merchandise to Cox, and sold merchandise to All-Star Legion. So that's the same setup for all of these. And Tucker Homes. A little bit later, we get on the 21st, we get notice that says Tucker Funeral Homes complained about a wrinkled ribbon on the floral arrangement. Bell Florist allows a $30 credit plus the sales tax of $150 back. So what we do, we're the ones giving the customer the refund. We have a sales tax back of $150. So what we're going to do, what are we getting? We're getting a return. So we debit sales tax returns opposite for the $30 and we refund the $150. And what we do is instead of giving Tucker Funeral Home cash back because they already owe us money from the transaction above, we subtract what they owe, $31.50. And if you really want to look at it, they owed $273. We take $31.50 away from that to find their new balance. And there are just a couple other transactions very similar. There's another from Price Savings and Loan that they bought a sale on account, and then they also had a return later of $26.25 that we credited them because it said withered blossoms in their floral arrangement. So that's us being the seller. Let's take a look at 9.2a, which is us buying this merchandise that we would be selling. Similar to what we're doing, but just to make sure, Barry's Pet Store records purchase transactions in the General Journal. In the General Ledger, Barry's Pet Store also uses the Accounts Payable Ledger, which we'll learn later. All right, so on April, I'm looking for something. Sorry, I was down at the bottom of my page. So our first one references the pet store. We are going to buy 10 Carefree pet beds from Blackburn Company for $399.90. And the terms are N30, net 30, FOB destination, which means that we do not have to pay the freight. So what are we getting? We're getting merchandise. Merchandise, which is a purchase, $399. How are we getting it on account? Just like we've always done, but instead of it being supplies or equipment, it's now a purchase. And in the next chapter, we pay it off, so we don't really need to worry about the terms yet. The second one said that we bought Marine Beta test kits for $83.93, and we had freight prepaid added to the invoice of $15. So in this case, if we have freight added, we have to add that in. So what are we getting? We're getting the merchandise for $83.93. How are we getting it? We're getting charged, or we also have the freight, and then we're putting the total balance on account. Freight does not get refunded, so later if we refund it, you can't get the $15 back. We have a couple more purchases on account. Here's two more examples. Purchase merchandise from Barrett, $719.85, and then we have a purchase with another freight charge. We total owe to Faulkner $1925.95. And again, this is us buying inventory. The next one is going to be a return. We are returning merchandise. So the original transaction was that we bought $18.49 in merchandise, and we are going to be issued. We're the one getting a credit memo. It says we're receiving a credit memo. Credit memo means no cash from Faulkner Company for merchandise returned. So we made a return of some of the purchase, and we got a credit of $589.13 back. And just like the last problem, we owed $1925.95. We are subtracting $589.13 to find out what our balance is. And the last one has just two more examples of a purchase to Rhodes, purchases accounts payable, and purchase to Solomon, and then Solomon had a return. Excuse these, I thought I deleted them. In the next part of this, we'll actually post these transactions to the general ledger and to the new subledgers. So Solomon had a products, they had a purchase return, we returned to them and got $76.25 on account. I hope this helps get you through the lesson. If you missed it, good luck with AP test.